Hey guys, welcome to another episode of Ironis Insights. I have another guest here, Michael Hession. He is the founder at The Perfect Asset. Michael, thank you for joining us today.
Hey Alex, thanks for having me. My pleasure.
Of course, where are you calling from today?
I am in the great little state of Rhode Island, just up the highway
Amazing.
from you.
And we were just chatting before. I'm way down south in New York City, so it's a pretty nice day out today though, so I'm not complaining. I appreciate you hopping on today. Really excited to hear about what you're doing at The Perfect Asset. But why don't you first just give us a background on how you got to where you are now?
How long do you have? Or how long should I? The reason I say that is because it does. I'll do the short version of it because it at 62, which I am 62 now. It's kind of
Looking great, man.
it's a journey, right? Getting to where I am now, and I started my first business when I was 25, a couple years out of college, just up the road in Massachusetts, and it was a small manufacturing business in the boating industry. So had a small shop. I made custom boat covers because used to do a lot of sailing and like work with my hands and being my own boss, and it was just kind of fell, and it was an opportunity that came my way, and I thought, oh, I could do that because there were so many things I didn't want to do. I didn't want to wear a suit. I didn't want to work in a corporate environment. So it checked a lot of boxes off. And I did that for 16 years. So I got to experience, I get really good at what I did and being a small business owner. And I also has learned some hard lessons along the way because I didn't set it up properly to exit. So I've burned out after 16 years and just basically stopped and sold some equipment because I didn't set it up to sell, because I insisted on doing it myself because I did it well. So it was kind of a lesson. And I remember a little bit before I stopped it in 2005, my wife and I started to experience the idea of leverage in real estate. I think I mentioned to you, we bought our first
Yeah.
home about a mile from here for buck 10, two family back in 2002. And so we lived in it. We had a tenant. So you start to go, huh, interesting. There's someone helping to pay the mortgage who's, you know, it's kind of inconvenient at times, but it was leverage, learning about leverage. And we sold that house right before the downturn in 2008 and made a nice, $100,000 profit. But we didn't set it up. Didn't live in it long enough to just take the proceeds. So we didn't exchange. So we exchanged it into a 6 unit in Providence, and then so we were very hands-on landlords, and it was the beginning of what was going to be our real estate empire. I envisioned, 20 years ago that I'd have, like 300 doors right now or something. But it didn't work out that way. 2008 hit. We were not set up to handle that. We were way over leveraged, mostly from the property and the business that my wife started. So we got hammered like a lot of people did in 2008 and actually went through bankruptcy. We decided to go that route. And which is tough. I had two little kids at the time. And
Man.
I just shared this because
How
it was
many properties did you have?
we just at that point it was just a 6 unit, a single 6 unit.
Yeah.
Yeah. And
Yeah.
it was as things got worse, we it was really hard to keep it rented because it was one of those neighborhoods that was if things were going well, it was fine. Things started to be a little shaky. We got there were a lot of multifamilies in the neighborhood, so a lot of them started to get boarded up, and it just kind of spiraled out of control. And I remember people breaking into the basements and cutting out the copper piping and stuff back in those days,
Hmm.
trying to make a buck. So, anyways, emerging out of that, and I also before that happened, I was doing some trading in the markets, options and futures and currencies, and learned a lot about how money works, and also how the sort of the powers that be, in a way, like the investment banks at that time, how they would get information a second before someone like me would, who was trading on his own. And it always just seemed really unfair to me. So it kind of informs what I do now. So coming out of bankruptcy, I was interested in money, and I thought, well, I had to work for I hadn't worked for anybody in 20 years, so I had to get a job. So I got a couple sales jobs, and I knew I wanted to get in as my own thing. And eventually, my wife suggested, well, maybe a life insurance company because there's a financial aspect to it, and you like the idea of money and helping people. So I started working for a company about back in 2013, and it was interesting because I started to learn about just the aspects of life insurance that I had no idea about. The idea of using it as a wealth vehicle, because at that point, all I knew was, it was a death benefit that someone will get when I go, you know.
Right.
So it was just kind of a long-winded way, but and what I do now, it's really helping people set up a really solid foundation with using this life insurance in particular, so that when things go sideways, they're not like just blindsided like we were.
Yeah. I
So,
mean, what an incredible story. And I mean, uh, inspiring too, working for yourself, running something for 16 years, getting burnt out, then
mhm.
getting this new real estate kick, right? You
Yep.
get your first townhouse and you rent out a unit and they're supplementing the mortgage and you're feeling great about that. I mean, I work with a ton of clients
Mhm.
who and here in New York, and they'll move from Manhattan out of their condo, or they're renting typically,
Mhm.
and they want more space, but they can't really afford to buy that space in the city, so they go to Brooklyn. We'll get them
Mhm.
a beautiful townhouse with a second unit, which they can
Yep.
rent out and leverage, like you said. And it
Mhm.
just really is. It makes a lot of sense.
Yes.
And you dove quickly into that six family, and then of course 2008 hits. I mean,
Yep.
it's like
Yeah.
you were off to the races, and then getting out of a bankruptcy, and then working for the man again, or actually for the first time, I should say, really.
20 years, yeah.
Yeah, in a
20,
while.
long time.
And you found your niche. So, all right, so let's talk about this.
Hmm.
Who who should be getting life insurance? What time? What age? And what do you exactly? And then I want to get into what exactly what kind of leverage we can
I
work
mean,
with
as
this.
soon as you can, because the way when you think about yes, it is life insurance, but there's the book behind me, Becoming Your Own Banker. This guy named Nelson Nash wrote that back in 2000, and the whole point of him writing it was really it was geared towards the financial services professionals who, over the last 50 years or so, everything has migrated and become so focused on the market. 401ks, IRAs, all that kind of thing. So naturally, all the professionals in that space, they gravitate towards that. They get their securities license because that's where the money is, assets under management. And that was my first insurance company. They really wanted me to do that, go down that path. I think it was my experience in trading. I didn't really have any interest in it. I was like, I don't want to have assets under management. We go into a bear market, and I'm like, I can't do anything to help you. You know, there's this thing out here that you have no control over, and they'll spout their average rates of return and historical performance, but it's all a matter of when you get in and when you get out, and access to capital. So Nelson wrote this book saying, look, you guys are missing the boat. These very long-standing whole life insurance companies offer these contracts and been around for 150 plus years in some cases that are brilliant vehicles for running your money through it. And you can start to approximate acting like a banker for yourself because of the way they're designed. And that means more control and certainty of your money, very safely, guaranteed growth, no market risk, so it doesn't vacillate with the stock market because it's not tied to it in any way. So that was really the impetus behind him, and that's my goal too. Is if you're if you are interested in taking control and being the captain of your own financial ship, you should look at utilizing these policies because that's why I named my company the Perfect Asset, because I think it is the perfect foundational asset that one can take advantage of. And I've got clients who are real estate investors, and the idea is you run your money through the policy first and then utilize it for your crypto holdings or your real estate or turning debt into wealth if you're someone who's just sort of middle American, doesn't have any investments. So it just does its thing and grows guaranteed, and you just utilize it and access it as you see
So
fit.
you have access to it.
Oh yeah, from when you start one of my policies that I use, within a couple of weeks, you have access to whatever's in the cash value. So it's pretty quick. So it's the idea is like if the way to think about these things is maximizing your savings and liquidity. If you have savings and liquidity sitting in a bank account somewhere, yes, it's convenient and somewhat safe up to a certain amount, but that's it. With these things, it's very safe. It's growing guaranteed. Even when you tap into it, you don't tap into the principal. You take loans out from the life insurance company collateralized by what's on your cash value. So it's a way to, and that keeps growing. And the idea is that you borrow against it, an unstructured loan, by the way, that you're not put on a payment program. So just, you have a lot of more control and certainty around it. And then the idea is that, yes, you now are taking the role of lender and client. And it makes sense for you as lender to pay yourself back as a lender. So I've got clients who they'll build enough cash value and say they have a car loan that still has 4 years on it. I had a client recently who was spending $1,000 a month on a new car, and she after her second year she had enough cash value. So basically, she took a loan from the life insurance company, paid off the car loan, but now instead of, you don't just stop it. You say, look, it behooves you to just, that $1,000 that was going away from you at 8% interest, never to be seen again, is now coming back into your system, and you're restocking the shelves for whatever you have to do next. So it's I think the way to think about it is we finance everything in life one way or the other. We either pay cash for it from our earnings, thus losing the ability for that money to earn any interest for us because it's gone. You get the item, but it's gone. Or you borrow from an outside lender and you pay them interest, also losing the ability for that money, your money that's coming in, from your job, from your earnings, and just going away. So it's a way to keep it under your control in this safe growing asset and then utilizing it for whatever you need to do. So I bet that, I mean, it's really probably my youngest clients are probably, and it's pretty unusual, like in their mid 20s, they're pretty savvy and they just are interested in, a lot of times they'll have their own business or they come into some money, but it's pretty rare. So usually it's, between like 35 and then I have some clients who get started when they're like 64 or so. So it's more of a mindset. They
Yeah.
kind of get that it's not that the system's rigged against them necessarily. It's just it doesn't necessarily, have their best interest in mind if they want to be a little bit more in charge of what's going on. And it's life insurance. So at some point we're all going to go, right? So there's going to be a death benefit that's going to go to somebody and pass along. So it's a unique asset. So that's why I call it the perfect asset.
Yeah, very interesting. I'm 35 now, so I think I hit your target market.
Yeah, well, you mean obviously you're a savvy guy, so I'm sure you have lots of various investments, and I would
Yep.
imagine. So it's anybody can, and obviously the downside or the entryway into this is your health. So, and the health and the ability to pay for it. And you don't, I've got some clients that are maybe their annual premiums as low as 10,000 a year. So it
Mhm.
doesn't have to be a ton of money to get started. It's just getting started. Up to, whatever the insurance companies will let you do and what your health will allow. So,
Very interesting.
mhm,
Um, yeah, I never really thought about this, as a potential. It's interesting when you're buying a property, right?
mhm,
And you mentioned a few examples of this. You mentioned basically borrowing against it,
yeah,
and I don't think it's something everyone thinks about and
no,
realizes that they can do. I mean, in fact, I know that because especially when you're talking to first-time home buyers, they don't even know how a loan works. They're like, who's your lender? Oh, well, I don't know. I bank with Chase. So
yeah,
it's a,
yeah.
well, okay, but let's talk
And they
about
got to come up with
structures and
what do they have to come up with these days? Is it 20%? I haven't bought a house in a while.
what's that? The rates right now?
No, like if what they have to put as a down payment, like a new,
Yeah, 20% is pretty standard.
yeah.
Um, you can always put a little more down, but
Yeah.
yeah, basically around 20%.
But that's a good example. Like if someone like that, I would say, look, let's look at your, because I'm kind of like I'm not a financial advisor. I can't call myself that just because
Yeah.
the government says I can't because I don't do any securities or anything because it's my
Yep.
choice. But I'm very much in an advisory role. So we'll look and see what do you have, and say you have that 20% sitting in a bank somewhere. Uh, let's get into a policy first. Then you create this safe growing asset and then also use it to buy your first home. So you, and then you, so if it makes sense and you're able to do it, people just don't realize. I think that people, especially high net worth individuals, they leverage
All
loans all the time,
other
right?
people's money, man.
Exactly. Yeah.
It's
That's the
always the
goal.
case. And every now and then, it depends on who you're talking to, right? Because I
Yeah.
shouldn't say always, because you also see a lot of these cash buyers out there that will they just don't want to deal with it, and here, this
Hmm.
is mine now, and that's fine.
Yeah.
Here's 5 million.
Hmm.
Um, but I want to talk about high yield savings account, maybe like a traditional brokerage account with a financial advisor versus, let's say putting our money, with you. What would make what's the trade off? What would make us, so let's say it's that down payment for the $1 million house, couple $100,000.
Hmm. So yeah, great question. So first, they don't give it to me. I'm an agent broker, and
Yep.
I'm contracted with five different. So the stipulation for infinite banking concept is that they're participating mutually owned whole life insurance companies in the US. You can do it in Canada too. There aren't as many choices, but you can do this in Canada. As far as I know, there's nowhere else in the world where the life insurance contracts are set up this way. So that's one thing. I think the best, the one in New York Life is probably the best known, or Northwestern. I don't use them. They they're a little bit more. You can kind of sort of do this, but my understanding is that if you take a loan out, they put you on a payment plan because they can. They just choose to be a little bit more, traditional, I suppose. So we don't use them ideally, but they're Mass Mutual. They're about a dozen companies. So they're mutually owned, meaning that when you own a policy, you own part of the company.
Hmm.
There's no share price, there's no stock price, there's no shareholders. So you can't have a situation like an Elon Musk owning enough shares where he can direct which way the company is going to go for good or ill. So we don't want that. So these companies, and they have a track record. Penn Mutual, one of my preferred carriers, I think 172 years. So the way to think about it is you're putting your money through and having it professionally managed by a real estate and bond company that has a long track record of being really good at what they do. And you think about in the case of these older companies, I never use it. All the companies I work with are at least 120 years old. So they have they're what are called participating. So they're dividend paying. In that world, it means they're profitable. When they're profitable, they disperse those back to all the policy owners. And what we do is we set them up so that just buys more life insurance, keeps it tax free, keeps the tax advantage, and then it just helps the whole thing grow. So that's part of it is you want to use the right company. And they think about the Penn Mutual, the world wars, the depressions, the recessions, the dot-com bubble, of 2008, and just they're really good at what they do, and they have a track record of maintaining through all these ups and downs.
Yeah.
And and also a lot of people don't realize too that the growth inside of these things when you set them up right is all net of taxes because the IRS treats the premiums going into these things as already having been taxed. So that's important to keep in mind too. So unlike you mentioned the savings account, like even a high yield savings account would have to be probably at 7 or 8% to match the 4% guaranteed inside one of these whole life insurance contracts because the growth is all net of taxes. And the 8% in the savings account is taxable. And they can change that anytime they want to because the bank controls it, right?
Yeah.
Whereas over here, it's guaranteed for your life. It's going to grow at a minimum guaranteed 4%. And then when you factor in the dividends, especially over time, these things are really long term. The internal growth, they're not investments. That's why I call it a perfect asset, not a perfect investment. However, internal growth in these things after 10 years or so can be like 8, 9, 10%, all net of taxes, internal growth inside of them.
And
But
you
the
can
real
pull from
point
and you
is
can pull from it.
exactly, and you can withdraw out of it too. But why would you want to? Because you don't want to mess with that principle. You want that
Yeah.
principle to. So the idea is you use it. I got a guy who he's a crypto investor. He's in underwriting right now, and he's doesn't have any debt. So usually I'll say, look, do you have like I mentioned earlier, that do you have a car loan? Do you have some some amount of money that's going away from you that you'll never see again, that we could go buy that debt and turn it into wealth. That's like one of the first things. And if you don't, then we look at something else. So he's in the crypto world. He's like, my crypto holdings are not big enough where I can liquidate it and, and retire. He's still working, but he can lend out in that world. He can lend out. You probably know this. He can lend out, part of his holdings at something like 8% to someone else. And I said, well, so maybe I'll load up my whole life policy with like $40,000 or so to get in the cash value right away. Then I'll use it to go over here and lend it out at 8%. And then the money that's coming back in here, I'll just pay the loan back to the insurance company. So I'm restocking the shelves because he knows he's probably going to buy another truck in a year or two.
Mhm.
So it's just everybody's a little bit different. So the idea is it's all about certainty and control. And also, as I mentioned before, these companies, they never put you on a payment plan. It just starts to accrue a simple interest rate of usually around 5%. Why do they do that? Because they're on the hook for a death benefit. So they simply, if you have outstanding loans, when that person passes away, the insured, and there's $100,000 outstanding loan, they just subtract it from the debt benefit.
Yep.
It's a very safe type of loan for them to do. So
What what do you think separates, people who build real wealth versus those who are just earn a lot and make a lot of money?
leverage, we talked about
Mhm.
using other people's money, because even in a way with these contracts, even though you're paying premiums and the growth inside of there, but the way you're actually taking loans from the company's general fund. So that's other people's money. So you're in a way you're tapping into everybody's paying premiums into, say, a Penn Mutual policy. Yes, you've paid your premiums too, but because you're taking a loan against it, it's collateralized by what's in your cash value, but it's coming out of their general fund. And so it's in a way it's utilizing other people's money
Mhm.
and not tapping into the principal. So I think that's one of the keys. If people are just making a bunch of money, and also there in Nelson's book, I highly recommend people read this, Becoming Your Own Banker,
Yeah.
because like the first third of it is all about overcoming human behavior. Because we all, we're humans. We tend to do things a certain way, and there's like the arrival syndrome. Like, say someone was making 50 grand a year, and then and they work their butt off, and they get to where they're making 120. They tend to, those expenses tend to rise with the income. So even though, they might lease a nicer car or something, a lot of times they're still like next to nothing in savings and liquidity because all they've done is just their income's gone up and their expenses have gone up to meet it. So a lot of the beginning of his book is about you have to overcome that because if you don't, when you come to retire, there's not going to be a whole lot there in all likelihood. The averages aren't good in the U.S. for normal, people just dependent on income. So you have to do something. And one of the great things you probably read Kiyosaki's books, right? The
Yep.
Rich Dad. One of the things that really jumps out to me, and it's in one of the, I'm partnered with a firm called Factum Financial as well out of Arizona. They have a great presentation, and it talks about how I remember when read his second book. I still have my old business, and you remember the quadrants, business owner, investor, self-employed, and employed.
Mhm.
And he was like, you want to get to the investor business owner side of the quadrant because that's where the leverage is. All
Mhm.
kinds of stuff, taxes, corporate structure, things you can do on that end that you can't do if you're just on the self-employed, worker person.
Yep.
And the thing is that for me, I realized my old business, I just owned my own job. It was really kind of crushing. After I read that book, it was so like, oh my God. Here I thought I was like this entrepreneur, and people say, oh, it's so cool that you have your own business. But really, I had no leverage. If I didn't work it, nothing got done,
Yeah. Yeah.
So, but the banking equation affects all four of them. So you think, again, back to what I said about financing, we finance everything. The banks have their hands in all four of those quadrants, whether you're an investor,
Yeah.
business owner, self-employed,
Oh
or
yeah.
employed. But they all have to deal with the banks. So if you can take that banking equation and have some control of it, you're just so better off, and it's such a peace of mind around it too. So
Yeah. No,
you know.
I love it.
Yeah.
I mean, that's a great answer. And it's very insightful. Now, I have one question before we jump, which,
Mhm.
I mean, if you could make one thing about your business easier, what would it be?
And people, the biggest challenge is having people understand it. One
Uh,
of my first mentors, he would say kiddingly, half kiddingly, when I was, and he's not from Texas, but he's been in Texas for a long time. So he has this like thick drawl. Like, I speak Martian. I teach people how to speak Martian. And people, what are you talking about? So that's because
yeah.
if you start thinking about like a banker, it's different than the way we're thought. So I just maybe people, I don't know, there's so much noise out there. You have to think for yourself and do your due diligence, and not be afraid of when it comes to money. I think a lot of people they get nervous about it, intimidated by it, and it's not frightening, but you have to take the time. It's really important because otherwise, at the end of you'll have all this money will come in over your lifetime, and most people there won't be much there at the end, and then you get into things like long-term care and all these things that can chip away at a legacy. It's really sad. So just, be open-minded to learn more about it, is what I would
I
say.
think
That's
you nailed it. I mean, education, man.
Yeah.
And I think everyone should, and like you said, at least be open to this conversation. And I mean, deep down, everyone doesn't really want to look at the bills, right? I mean,
Or
they don't want,
401ks, right? I remember people, I don't even look at my 401k. If
yeah.
that's the market, I don't even want to, I'll look at it 20 years from now and hope that there's something in it.
It's the same. Like, I don't want to look at my accounts. I don't want to look at the balance. Like,
Yeah.
and there's this fear there, but there's an overwhelming sense of control and calmness when you can actually get a handle on it and have a plan.
Yep.
Even if you may not be throwing hundreds of thousands of dollars in it right away, but if you have a plan and you stick to it and you have the right advisor,
Yep.
that is where you can take control not only
Yep.
of your life, but of your legacy as well.
Real quick, and before we close, I get this from my mentor, was the idea of, if you think about it, obviously there's a broader economy, the U.S. economy, the world economy, all this stuff you hear about, and that's important. But the most important one is your own. If you're a single guy working in Manhattan or something, and you're 25 years old and just a year out of college, whatever, or you have a family, the money that comes into your control and exit, that's the most important economic system to you for the rest of your life. So it's important to be on top of it, and don't let it be frightening, and get the right guidance, and because there's a lot of nonsense out there too on the financial and in my just do your due diligence, because they're in a lot of I find it a lot with this sort of typical financial world is they would rather. I've even lost clients to this. They were talked into saying, no, all that money sitting in cash value in your policies would be better used if we let that thing lapse and stick it in some sort of funds that we control and earn fees on.
Hmm.
And it just breaks my heart because he could have done both.
Yeah.
Now he doesn't have that one. He just has that one, and they talked him into it because that again, that's that thinking. They're like, oh, life insurance is just strictly for protection. We'll do some term life, but everything else should be invested, and that's it's so you got to be careful of that too.
Hmm.
And think about what is the benefit that a professional. You have to look at what's their motivation. In my case, the benefit that my clients get out is so far outweighs what I make in commissions from the life insurance company.
Hmm.
It's kind of laughable, and I'm fine with it. So you just got to be mindful of that too. So
Well, you're really making a difference, and it sounds like helping every one of your clients. So I really appreciate you hopping on.
yeah,
Great chatting with you. Real quick, where can our listeners find you and your company?
yeah. Just go to my website. It's theperfectasset.com.
Perfect.
Yeah,
Awesome. Well, thank you so much,
you're
and I hope
welcome,
you enjoy the
Alex.
rest of
Thank you.
your
It was
day.
great fun. Take care.
Thanks.